Imagine buying a tiny company today and watching it explode into a household name tomorrow. That's the dream for many investors, spotting the next Apple or Amazon before anyone else even notices. But with all eyes on the Federal Reserve's interest rate moves and the hype around artificial intelligence stocks, it's easy to miss what's happening in the world of small-cap companies, the little guys that might just become the next market giants. Let's dig into why small-cap stocks are suddenly back in the spotlight and how a top-rated portfolio manager sees big opportunities where others aren't even looking. First, let's talk about what small caps really are. In simple terms, these are companies with a market value, or market cap, typically between $300 million and $2 billion. They're often more nimble, more innovative, and yes, riskier than their larger counterparts. But they're also the companies that can sometimes deliver outsized returns if you get in before the crowd. So why are small caps getting attention now? According to a 5-star portfolio manager, someone whose performance has consistently ranked among the best, even through tough markets, the environment is starting to look really interesting for these stocks. And it's not just because they're undervalued or overlooked. One big factor is the potential for mergers and acquisitions, what Wall Street calls M&A activity. Here's what's happening. Larger companies, flush with cash and hungry for growth, are on the lookout for smaller firms they can buy up. This is especially true when big firms hit a wall with their own innovation or face slowing revenue growth. Instead of building something new from scratch, they often find it faster and cheaper to simply buy a promising up-and-comer. For investors, this can mean a sudden premium on the share price if one of your small-cap holdings becomes a takeover target. But why now? Well, for starters, small-cap stocks have been lagging behind their bigger peers for quite a while. Over the past 2 years, the S&P 500, which is dominated by mega-cap tech names like Microsoft, Apple, and Nvidia, has outperformed the Russell 2000, an index made up of small-cap companies. Some of this gap is due to concerns about higher interest rates, which tend to hit smaller, less established companies harder. When borrowing gets more expensive, it's tougher for smaller firms to fund their growth. But here's where things get interesting. The Federal Reserve has signaled that it may be done raising rates for now, and many investors are starting to bet that cuts could be on the horizon. If that happens, the cost of capital goes down, and suddenly, smaller companies have an easier time borrowing money to invest in their businesses. Plus, big companies with lots of cash might be more willing to pay up for acquisitions. This 5-star manager points out that we're also seeing a shift in investor sentiment. With the AI trade feeling a bit crowded and valuations for the biggest stocks looking stretched, professionals and everyday investors alike are starting to hunt for bargains elsewhere. Historically, when small caps are this cheap relative to large caps, they've often bounced back in a big way. In fact, over the past 40 years, there have been multiple occasions where small-cap stocks have outperformed the S&P 500 by double digits in the years following a period of underperformance. Let's not forget the innovation factor. Many of today's household names, think Netflix, Tesla, or even Starbucks, were once scrappy small caps themselves. Small companies are often quicker to adapt, launch new products, or pivot when the market shifts. And when larger competitors are bogged down by bureaucracy or their own sheer size, these nimble players can swoop in and grab market share. But there's another angle here. The M&A, or merger and acquisition, wave could be picking up steam. When the economy stabilizes and borrowing costs drop, bigger fish start looking for smaller fish to swallow. Just look at the history books. After the financial crisis of 2008, there was a massive surge in M&A activity as big firms scooped up undervalued companies. The same thing happened after the dot-com bust. Investors who held shares in those takeover targets often saw handsome rewards. Now, it's important to be realistic. Small-cap stocks come with higher risks. They can be more volatile, and not every small company will turn into the next big thing. Some will stumble, and some might even disappear. That's why experts like this 5-star manager stress the importance of diversification. Don't put all your eggs in one basket. If you're going to dip your toes into small caps, maybe use an index fund or an actively managed mutual fund with a track record of finding winners. Another thing to keep in mind, small cap stocks aren't just about tech. There are opportunities in healthcare, industrials, consumer goods, and more. Areas like medical technology, clean energy, and specialty manufacturing are fertile ground for innovation and potentially for M&A deals. When big companies want to break into a new market or beef up their product lineup, they often look to acquire rather than build from scratch. So, what does all this mean for the everyday investor? If you've been glued to mega-cap tech stocks or worried about what the Fed will do next, it might be time to broaden your horizons. With small caps trading at a discount and the possibility of a pickup in M&A activity, there could be diamonds in the rough just waiting to be discovered. Of course, no investment is without risk, and small caps demand patience and a strong stomach for volatility. But history shows that those willing to look beyond the obvious trends, to spot the little companies before they get big, can sometimes reap the biggest rewards. So the next time you scan your portfolio, ask yourself, are you only betting on the giants of today, or are you keeping an eye out for the giants of tomorrow? The next wave of market leaders could be hiding in plain sight, just waiting for someone to take notice. Maybe with a bit of research and a willingness to think outside the box, that someone could be you.